left in 2000. Oh, do we have recording?
I'm recording it. It won't be live streamed, but it is being
Okay.
recorded, and we'll try to set it up so it goes on the channel.
Excellent. So I served, our paths crossed a little bit. I know that Jack did amazing work when he was here as a non-voting member. As we know from Matt Scaves and Jim Bradley being on the investment committee, they share their expertise and really help out the investment committee a lot. So we're looking forward to having Jack on the committee with us. And I would like to transfer to have Tracy say a few words, because Tracy's worked quite extensively with Jack, and I'd like for you to share a few words, if you would, on Jack before we bring it to a vote.
Thank you. Happy to. Happy to present this item for Jack. As Chair Martin mentioned, he did serve in the same role from 2009 to 2017, and I got to know him very well then. He has over 30 years of institutional investment experience. He's a managing partner with Harpswell Capital Advisors located in Falmouth, serving as their chief investment officer and strategist. And he takes the lead on key client relationships and devotes considerable time to fund manager selection and tactical positions. So a lot of relevant knowledge there that will help us out. In addition, he previously managed Harpswell Capital Management, a hedge fund with global clientele. He was a principal and senior analyst at Vanguard, a vice president and portfolio manager at Bryn Mawr Capital, and a fixed income analyst at MetLife. Prior to his career in investment, he served as a financial expert for Federal Energy Regulatory Commission and as the press assistant to Senate Majority Leader George Mitchell. Further, he has served on many boards and committees that I had the pleasure to serve on with him. He was the chair of Goodwill Hinckley, and he's also been the chair or on the committee of Portland Museum of Art and a governor appointed position on Maine's Next Gen 529 Advisory Committee. He holds degrees from Hobart College and the London School of Economics, is an avid runner, a hiker, a photographer, and an angler. And with that introduction, happy to take any questions, but this is an action item today, and thank you for considering Jack. I think he would be an excellent addition.
Thank you, Tracy. And just for information, we're able to have up to 5 non-voting members. Currently, we're at 3, but we have one that's the term is coming up. Correct? That'd be Tim from.
Yeah.
Yeah. So we'll have currently 3, but we could have up to 5 non-voting members, and the more the merrier. I mean, the investment field, the industry is complicated, and it's good to have a lot of strong minds in this area on the board with us. So much appreciated for the time that you spend, Jim, Matt, and Jack, if you're on. Thank you for agreeing to serve. So without further ado, I'd like to read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the appointment of John Moore to a 3-year term as a non-voting, non-trustee member of the Investment Committee, effective March 6, 2025. Are there any questions or discussion? Hearing none.
It's always good to have 2 John Moores. It's always good to have 2 John Moores.
I know, 2 Kellys, 2 John Moores. Luckily, our non-voting members decided to go by Jack, so. Can I have a motion?
So moved.
Second.
Moved by John Moore, second Trustee Moore, and seconded by Trustee Baldacci. And Beth, if you could take a roll, please.
Yes, Trustee Martin,
Yes, approve.
Trustee Riley,
Yes.
Trustee Moore,
Yes.
Trustee Baldacci.
Yes.
The motion carries.
Excellent. Thank you. Moving forward, going to transfer the mic over to Mike Pratico and Barry Schmidt, principals for Cap Trust Financial Advisors. They'll provide us with their quarterly update on the defined contribution plan. And without further ado, I will transfer. Can't remember which one is
Yep.
going to grab the mic first.
I think it's going to be me, Trustee Martin, to start. And so I'll start with some basic industry updates and go through markets, which frankly have changed pretty dramatically since our materials were put together about a month ago. So I'll go through both a wrap up of the 2024 and then talk a little bit about 2025 and looking forward as well. And then I'm going to hand it over to Barry. Barry's going to go through the scorecard as well as what we refer to as a share class analysis, where we're looking at the share classes of the funds. It should be a really straightforward quarterly review. This is just a reminder, it's the fourth quarter review of 2024. We're also looking at the full year 2024, and it was another really good year in the markets, another really good year for investors and participants in the UMaine system plan as well. So again, should be pretty straightforward, but please stop and ask any questions throughout. There's a number of what we refer to as just kind of industry updates or topical spotlights that I wanted to really briefly talk about. I don't think this committee needs to spend a lot of time on this, but we do go through these in more detail with Tracy and Kelly in advance of the meeting. So I do feel like they're getting certainly the time that they need. The only one on this page I really wanted to point out was the increase in catch-up provision contributions. This is something that's getting a lot of attention. Basically, it allows people between the age of 60 and 63 to do an additional $3,750 in addition to their normal catch-up. So they can do a total of about a little over $11,000 via catch-up if you fall within that range. So this is something that certainly will be well received for participants who fall in that age range that are really good savers. It gives them the opportunity to save a bit more. Just a reminder, one of the things that we'll be talking about going into next year, though, is the fact that all catch-up contributions are going to have to be made via the Roth feature for people making over $145,000. This was a provision that was part of the Secure Act and was supposed to go in place at the start of 2025. It was delayed for a lot of different reasons, not the least of which is very few record keepers could handle it at that point in time. So it was delayed until 1/1/26. There's still a lot of lobbying going on trying to get a further delay. I doubt that's going to happen. Frankly, that one provision on paper pays for a lot of the other provisions within the Secure Act. So I think we just need to be prepared for that to go into place. And it's going to, for people who are all of a sudden doing the full 11,250, if you're making over 145,000, that will change the way that money gets saved, and it will require obviously some work from payroll and HR and IT and a lot of different areas. But I think we need to be prepared for that to happen. TIAA, as a record keeper, I should point out, is prepared to administer that provision. The next page, again, I won't spend a lot of time on, but over the last couple of years, I feel like Barry and I have spoken about this potential for 403B plans to be eligible to be able to utilize collective investment trust vehicles, and that, as we pointed out, would save the university participants tens, if not hundreds of thousands of dollars in fees and expenses. Really, the biggest beneficiaries to that change would basically be large 403B plans like yourselves. So we're lobbying hard for that provision. It actually has gotten pretty broad bipartisan support as well. Yet, for some reason, I don't claim to understand everything that goes on in Washington, D.C., but for some reason, we just can't seem to get that provision across the finish line. Quick update, it is on the table again for this year. We had people in Washington, D.C. last month lobbying really, really hard on your behalf and all of our 403B clients' behalf. But so far, we just haven't seen any movement. We thought it was a good opportunity, since we talk about CITs so much, to just put this slide in here that shows the difference between mutual funds, collective investment trust, and insurance separate accounts. So again, I won't read through this, but CITs or collective investment trusts are something that have been widely used in 401k plans really for decades at this point. And in my opinion, it's long overdue that 403B plans be able to utilize them, but for whatever reason, we just haven't gotten there yet. So this is just an interesting slide that I thought you folks would appreciate since we talk about CITs and CIT legislation so much. And then the final slide I wanted to point out are just really some statistics on the importance of financial wellness. I know that, TIA does a really nice job with education and communication. This has certainly become a big part of CapTrust business model as well. We have a comprehensive financial wellness program that's available to clients. And again, this just shows the importance of that. And I think probably is going to continue to be important and get more important over time as well. Again, any questions on just those quick updates before I shift to the markets? Okay, so just a reminder again, this is the full year 2024. So the solid bars on this page represent the full year performance. The striped bars represent the fourth quarter of 2024. And you can see, obviously, the fourth quarter was tough. Other than US large cap stocks, which closed up about 2.5% for the quarter, emerging equities were down, real estate was down, developed international stocks were down. And you can see even the aggregate US aggregate bond index, which had been having a really good year up until the fourth quarter, had a difficult fourth quarter as well. The good news is when we look at full year performance, it was another very, very strong year for investors in diversified portfolios, but especially portfolios that happen to be overweighted to US domestic equities. You can see the S&P 500 closed up 25% for the year. That's coming off a year in 2023 where the S&P 500 closed up 23%. We do not see back-to-back 20% years in the S&P 500 very often. If that were to happen in 2025, it would be unprecedented. We've never had 3 years in a row where the S&P closed above 20%. Frankly, going into this year and in the early stages of this year, it seemed like we might have a chance at that. But unfortunately, over the last 60 days or so, we've really seen things turn, and the S&P has actually turned negative on a year-to-date basis through yesterday. And today, as I look at the early numbers, the pre-trading numbers, looks like it might be another down day as well. So I'll talk a little bit more about our forward-looking economic thoughts, but I do want to just, emphasize 2024 was certainly a very good year in the markets. Just while I'm on this page, though, again, S&P down 50 basis points year to date through yesterday. Developed international stocks, that's the EFI or EAFE benchmark, actually doing quite well. The EFI benchmark is up about 10% on a year-to-date basis. We haven't seen that dynamic where international equities have exceeded U.S. equities for quite some time. And the good news for bond investors is the U.S. aggregate bond index is up about 230 basis points for the year. It's been a really, really challenging run the last couple of years for bond investors. You could even argue last year as well. So it's nice to see, the ag back in, real positive territory. I did want to dig a little bit beneath the surface, though, and talk about the performance across market caps and styles as well, because as Barry goes through the performance of the individual funds, a lot of the funds that are underperforming, it's really explained by, either these stylistic headwinds that I'm going to talk about, or frankly, funds that are doing especially well are also obviously impacted by these things. But you can see again, if we focus on the middle bottom of this page, it was a really good year across all market caps and all styles. Large cap, mid cap, small cap, growth, value blend, all closed in the positive. The worst performing asset class last year was small cap value, which was still up 8%. The best performing asset class was large cap growth, which was up over 33%. That really continues to be driven by just a handful of stocks. I know everyone probably is sick of the phrase Magnificent Seven or Mag 7 stocks, Facebook, Apple, Amazon, Meta, Google, I'm sure a number of stocks like that.
NVIDIA.
Kind of in and out of that. Go ahead, Barry.
NVIDIA.
NVIDIA, yeah. NVIDIA is another really, really key one. But, the bottom line is the more as a manager or as an investor, you kind of leaned into growth without even worrying about valuations, just kind of growth at any cost, the better you did as an investor. That's switched. So as we talk about 2025, we're also already seeing a rotation in the market. But again, this chart I think when you look at funds that are either doing exceptionally well or maybe underperforming a bit, it's generally the result of, either these stylistic headwinds or tailwinds, depending on where your money is concentrated. But again, overall, you can see diversified investors did really, really well last year. From a forward-looking perspective, I would say we're going to summarize 2025 with one word, and that is uncertainty. And, unfortunately, markets hate uncertainty. If there's one thing markets love is certainty. And obviously the flip side of that is they really hate uncertainty. And that's driven by a number of different things. These headwinds and tailwinds that we put together, they're still very relevant. But again, we're still waiting for a lot of clarity. All eyes still on the Fed. What we're referring to here, obviously, is what the Federal Reserve is going to do around interest rates. Going into the end of 2024, the Fed started to reduce rates. Inflation numbers were coming down. We weren't at that 2% level that they were looking for, but inflation numbers were down and seemed to be holding right around 3%, which the Fed seemed to be happy with. Unemployment numbers remained pretty strong as well. And as most people know on this committee, those are really the only two things the Fed cares about: unemployment and inflation. They put a pause on the rate cuts. We were expecting potentially several rate cuts towards the end of 2024. After a couple rate cuts, they decided to put a pause on those. Initially, market's expectation and our expectation was going into 2025, they were going to start, with some rate cuts in 2025. Really, our expectations and the market's expectations have changed dramatically. We are at the point where we don't expect any further rate cuts until at the very earliest June. And frankly, our sense is that we probably will not see further rate cuts in 2025 at this point. Sorry about that. At this point. So again, that's a really critical item. Policy pressures, if we were prioritizing these bullets in terms of headwinds or potential headwinds, I would probably move policy pressures up to the top of this page at this point. There are obviously several policy initiatives going on with the new administration all at the same time. Again, really unprecedented in terms of the number and the number of policy initiatives that we're seeing. And it's creating, from an investment perspective, a really increasingly complex landscape. Again, it kind of goes back to uncertainty. When we talk about, one of the key ones, obviously, is what's going to happen around tariffs. When the first round of tariffs was announced, the markets responded very poorly. We saw that 30-day delay on the tariffs for Canada, Mexico, and China. Markets responded positively, came back to basically flat, after the delay was announced. Then yesterday, the tariffs went back into place. And then suddenly there's this potential for the tariffs being lifted on the big three automakers. So again, regardless of where you fall on, whether these policies make sense or not, they do create an environment of uncertainty. And that's something that markets really don't like, not just around, the tariffs themselves, but what are some of the residual policies going to be around tariffs? Like, are the tariffs going to then be passed on to consumers? That obviously would increase inflation numbers. Are they going to be absorbed by companies? That may or probably likely will increase or decrease profitability. One of the big issues is, what's the impact going to be on the mega tech giants? I mentioned, those are the companies that are really driving the market as well. So, this one, I feel like we could almost just list this one bullet as a potential headwind. The bottom line is, I think we need to expect volatility over the course of 2025. From a tailwind perspective, certainly going into this year, I would say towards the end of 2024, I've actually never heard our chief investment officer be so optimistic going into a year. The feeling was the U.S. economy was really pretty sound. Unemployment was solid. Inflation was coming down. So going into 2025, there was certainly a feeling of optimism. Even, with the new administration coming in, some of the pro-growth policies certainly are things that the markets would really favor and may still really favor as well. Since then, I will tell you that our position has rotated a bit to really being far more cautious than optimistic, just in what we've seen in the last 60 days or so. And again, it's hard to do market commentary these days without it sounding political. It's not meant to sound, not meant to be political in any way. It's just the reality is, again, if you go back to, what I said earlier, markets don't like uncertainty. And, certainly that's what we're looking at right now is a lot of uncertainty. Still some great headwinds. Again, pro-growth policies, corporate profits, continue to be good. AI productivity has actually been meaningful. I know it's something that even at CapTrust, we've started to incorporate aspects of AI into our day-to-day business, and it's really helped to increase with productivity. But I would say, the theme of uncertainty and caution is really what we're looking at right now. This could all change, if we did this market commentary, frankly, in 2 weeks based on what goes on with, the policy initiatives and the tariffs and things of that nature. It could change, but, that's certainly our current positioning. The next several slides, I think, are really interesting. I won't spend a lot of time on them, but they basically go through each one of those bullet points in detail, and kind of support what we're talking about with different data. This slide, you can see where we talk about market expectations on interest rates and what the expectations are now. The blue line representing what our expectations were for interest rates, the yellow line really representing the current expectations for interest rates. And then some of the other slides talk about, again, the profitability, I should say the impact of the Magnificent Seven stocks on the S&P 500, which make up now an enormous part of the S&P 500. If you were to remove these 7 stocks from the S&P 500 last year, we would have been looking at single-digit returns, as opposed to the 25+% returns that we had last year. So I want to hand it over to Barry to talk specifically about the UMaine System Plan. But before I do that, any questions at all from either a market perspective or some of the industry updates and topical spotlights that I talked about? Okay, so Barry, I'm going to stop sharing and hopefully turn over the sharing to you at this point.
I'm sorry, I thought you were continuing to.
Oh, do you want me to? I'm happy.
Yeah.
Okay,
You
so why don't you can start talking and I'll
Okay.
start sharing again.
Let's go to our page 28, Mike, just to look at the stair step. Just a reminder, because these are participant-directed
Okay.
plans. Page.
So Barry, just in terms of the page numbers, Barry, I'm using the board packet.
Okay, so 26.
Yeah, 23. Stair step.
Yes, a stair step. Remind the committee, these are participant-directed plans, and so we offer a menu of investment offerings to plan participants to meet them based on their own risk preferences. As you recall, the last committee meeting, the trustees approved 2 changes. One is the Victory Sycamore Small Company Opportunities Fund will be replaced by the Vanguard Small Cap Value Index on March 19th. And we also added the Vanguard FTSE Social Index as another environmental social governance fund in the portfolio today. Again, just to remind the committee on specific to ESG, when we evaluate ESG offerings, we are evaluating them based on financial factors alone. We go to the next page, Mike. As of the end of the year, we had a little over $2 billion in overall assets. It is a good reminder of kind of where we were when we first started with the system. You look at the bottom in particular. I think Voya perhaps had about $170 million. And over time, we have certainly made a lot of headway in terms of those legacy vendors out there. There's certainly some more work to do, but you can see we're down to about $40 million with our former record keepers prior to the switch to TIA as the sole record keeper. Yeah, if you look at total assets, we just break these down into various asset classes. So you think about stable value represented by the TIA traditional, that still is the single largest holding in the UMaine system. You think about, especially when the Fed was raising rates so dramatically, TIA responded pretty quickly and they have a really good return. I think the crediting rate now is still over 5%. So really a strong crediting rate, especially for those that are getting close to retirement. The asset allocation, target date funds, that also includes CREF Social Choice, which is a balanced fund offering about 20%. And it starts going down from there. Global equity is just CREF stock. We're going to talk about the funds in yellow here, but just to look at the overall portfolio in descending market value order. If you look at the second line, the Vanguard Retirement Series, incrementally over time, this is our default. When a participant joins the UMaine system, they don't make an election. They automatically go into the Vanguard Target Retirement Series based on their projected retirement age of 65. We see this incrementally increasing to where ultimately, if we're looking at this, 5 years from now, 10 years from now, that will be the single largest holding. Certainly, they're garnering the most future contributions today with respect to the participant investments. If you just go down, CREF stock represents a little over 12%. One thing I do think that something we ought to consider doing, if you'll notice, we have CREF stock R3 listed at 242 million, and you go right down below the JP Morgan Equity Income Fund, CREF stock R4 at about 45 million. Because we went to a full fee transparency structure, we were able to take advantage of a lower share class of the CREF stock offering. However, the CREF stock R3 represents legacy contracts to where we can't control. All the money that we could control, we migrated to the lower cost CREF stock R4 share class. But you'll see CREF stock, you'll see CREF Social Choice R3 versus R4, CREF Inflation Linked Bond R3 versus R4. In our view, there is no reason why a participant should not migrate their assets to the lower cost version of those offerings. So we might want to work Tracy offline in terms of some sort of communication to plan participants, reminding them of this opportunity. I'll stop there for any questions or comments.
Yeah, and I would just add to that, Barry, that's really a TIA issue. I mean, they should be, and we've brought this up with them in the past. They also recognize that there's no reason for money to be sitting in a more expensive share class of the exact same fund. So we can try to Barry's point, put some additional pressure on them in 2025.
Mike, if we go to the scorecard.
Got a quick question on that.
Sure.
Is there any way for them to remove that from the platform? I guess that would
No.
probably be no?
Because it's the individual participant has those assets. So it would be a hand-to-hand combat where the individual participant must elect to go into the cheaper version of the same share class. We see no reason why they shouldn't, but it takes effort on the individual participants' behalf.
In a perfect world, if we were able to do that, then could it be removed?
Explain that a little. Explain your question a little bit more, Trustee Martin.
So if all participants, which is this is kind of probably a silly question because that probably wouldn't happen, but if all participants were able to move from the more expensive share class to the inexpensive share class, at that point, if there's nobody in it,
we could remove. Yes, yeah.
You could remove. Okay,
Yeah.
so
Once they get out of that, they're going from a legacy annuity contract to a group contract.
Mhm.
They can't go the other way. They can't go back. So technically speaking, if all assets were removed from the R3 share class, they would be removed from your menu.
But it's a really good question because there was a time on the TIA platform where you were required to offer certain investments. It was mandated that you offer, for example, CREF stock as an active investment. That's not the case anymore. But it's the individual contracts that are really preventing us from taking action.
Thank you.
Can I just clarify a point there? So you're saying we can't access as a group contract asset, the lower price share class until we have significant assets that are in the individual contracts that have moved to that? Is it because we lack like enough assets in that because many of them still remain as individual contracts?
No, and Mike, let's just go back that page just for a second, just to make sure we're understand you all are understanding this. So when we made the decision to go from the R3 share class to the R4 share class, because we did the fee transparency, that gave us the opportunity to do so. Any money that we're already in the group contracts with respect to those funds were moved at an institutional level. What remains, if you look here, the Crefstock R3, what remains is prior to that point, all those assets back, accumulated assets, are in legacy annuity contracts. Does that answer your question, Tracy?
Yes, I apologize. I see you highlighted the R4s. I wasn't picking up that we have two share classes, of course.
Okay, all right.
That's probably my fault, but yeah, total.
We could have highlighted it
no,
better.
thank
That's
you.
fine. We could have done a little better job of highlighting it.
So I missed it, but happy to work with our relationship manager
Yeah.
to hopefully educate participants.
If we go to the scorecard, just to orient Mr. Moore to our scoring system, at the highest level, our scoring system is not intended to, if a fund scores a particular score, then we must act. It just draws out certain attributes of a fund as we're talking through this. It's based on a 100-point scale. The first 8 columns represent 70% of our scoring, kind of rear view mirror, and the remaining 2 categories are forward-looking views, qualitative views. Again, if the fund scores an 80 or above, it's in good standing. If it scores between a 70 and a 79, it's marked for review. If it scores below a 70, it's considered for termination. So various attributes, we look at risk-adjusted performance, both 3-year and 5-year were more punitive for 5-year underperformance. Peer relative, the same thing, making sure they stick to their style. Confidence rating is simply information ratio. So we're measuring the volatility of excess return. We want more consistent managers, especially in participant directed plans. So that's kind of just give you and orient you into our scoring system. So the first one I want to look at, we tend to focus on the problem children. So I'm going to focus on CREF Social Choice, JP Morgan Equity Income, and Euro Pacific Growth Fund on this particular page. But CREF Social Choice, as we recall last committee meeting, we made a decision to add the Vanguard FTSE Social Index. As you all know, with an ESG offering, there's no particular standard out there. CREF Social Choice has a particular manner in which they're screening out or screening in funds. The same thing holds true with the Vanguard FTSE Social Index. So with CREF Social Choice in particular, they screened out Apple, Alphabet, and Amazon. And if you think about, Mike just talked about the Magnificent Seven and performance of the Magnificent Seven over the last 2 years, that really hurt their performance. They screened out Apple based on controversies that severely weigh down its corporate behavior practices, supply chain standards. They screened out Alphabet due to some class action lawsuits and paying hiring discrimination. They screened out Amazon for labor management issues and supply chain standards. So that really is the root cause of why the CREF Social Choice Fund is scoring a 77 in our scoring system. Again, if this fund continues to falter, we are looking at this based on financial factors alone. And if the fund scores poorly, we would make the necessary steps to look at some alternatives. We're not there yet, but the reasons for that is there's some of their ESG screens.
And I do think adding the Vanguard FTSE Social Index, certainly if that were the case, it would be very easy just to map the assets into the FTSE index.
for those that we can map, just to
Yeah, great.
go
Yeah,
back to
thanks.
the
Yeah, great
our
point.
former conversation. The JP Morgan equity income, this is an improving story. Mike talked about kind of the dominance of the Magnet 7 over the last couple of years. JP Morgan equity income is more of a bottom-up traditional value manager, so they had a lot less exposure to some of those Mag 7 stocks as the market has rotated. In fact, like if you look at performance through yesterday, the large cap value sector was up almost 3% versus large cap growth down 3%. Consequently, the JP Morgan equity income fund now is in the 20th percentile on a quarter to date basis and a 40th percentile on a 1 year basis. So this is an improving story. We just think it's based on the market rotation. It's not going to be long before JP Morgan passes our policy guidelines. I think the one fund that causes us more consternation is the Euro Pacific Growth Fund. This is fund that we've been talking about this fund over the last several quarters. Just to remind the committee, this particular fund invests in securities domiciled outside the U.S. They tend to be a little more growth bias in nature. And unlike the U.S. market that has been more dominated by large cap growth sector, the international market has been more dominated by the value sector. So it's been a little bit of a headwind for them. In addition, they have about 17% of the portfolio in emerging markets, and emerging markets has underperformed vis-a-vis the developed market international. So we want to give the manager some room to navigate the kind of a challenging market environment. But I will say our patience is starting to wear thin on this manager. If we don't see improvement over the next quarter or two, we could envision at least getting with the trustees a recommendation for some alternatives. Well, and having said all that, the last 2 years we have seen the Euro Pacific Growth Fund. They're at median. They're beating their peers barely, but they are beating their peers over the last 2 years. We think. We hope that's a good sign, but I looked at more recent performance, and that has dissipated somewhat. So we'll see where they're at the end of March. The next page, Victory Sycamore. I'm not going to talk about that fund because we made the decision to replace that fund with the Vanguard Small Cap Value Index. Again, March 19th is the date that changed over. And go ahead. And the last fund I wanted to talk, well, I want to talk about Vanguard Target Retirement just for a second. We do have a little bit of a different scoring from Mr. Moore's perspective. It's more on a target date fund. It's more about the assumptions they make ultimately to create the glide path. It's more about portfolio construction than it is about necessarily performance, although we look at performance. So we weight our performance more towards portfolio construction. I think 60% of performance, 40% of the overall scoring. Vanguard, and if you look at their target date funds, Vanguard has a more global allocation view, so they have a tendency to have a little more international exposure than perhaps some other target date managers. Think about T. Rowe Price, et cetera. However, as Mike had alluded, so far through mid-February, the EFA is up over 10%. The emerging markets over 4%. So we would anticipate that we would have a pretty strong quarter for the Vanguard Target Retirement Series. And if you look at the next page again, index products, we want to make sure you have low tracking error, meaning that you're replicating the benchmark, and low fees. And Vanguard is known for both of those. The last one is the TIAA Real Estate Fund. As you recall, this is a unique offering with TIAA. It is private real estate, so bricks and mortar, office buildings, commercial real estate, residential type complexes. If you think about where we were COVID, post-COVID, you think about commercial real estate, valuations have come down upwards of 40% on commercial real estate post-COVID. And it's not like they can just readjust their portfolio overnight. So they are certainly trying to adjust their portfolio to do or have less reliance on commercial real estate. It simply takes some time to do that. having said that, in 2022, and when the markets were going crazy, TI Real Estate and TI Traditional were the only two funds in the portfolio that actually had positive performance. But we're going to see the TI Real Estate Fund probably marked for review for the next several quarters until they are able to readjust their portfolios in a way that's prudent to the current investors in the portfolio. Any questions? Go ahead. I see your hand raised. Go ahead.
Hi, Barry. Thank you. I just was wondering, what sort of tools or resources do we provide participants to help them navigate these decisions? Whether that's, is a target date fund appropriate for me? Is a passive fund versus an active fund appropriate for me? How would somebody, as a participant who's a relative layperson, understand that their social choice fund doesn't include key Mag 7 stocks, or that the value fund might have those same shortcomings? All right, like what resources are available to our participants to help them make the right decisions for themselves?
That's a really good question. The short answer is we are reliant upon TIAA to be that educator. However, it's relying upon the individual participant to engage with the TIA representative and discusses, have those types of conversations. We don't, as a rule, communicate, the various components of each individual fund and considerations for that. But heretofore, we've relied upon TIA for that messaging, rightly or wrongly.
Yeah. And also, I should point out, a number of participants do have individual advisors that they work with that help with their portfolio construction. I think, that question shows the value of a good individual advisor and, the help that they can provide participants as well.
And I would also add, all employees have an opportunity to work individually with a TIA representative, but also have an automatic tool, the asset allocation advisor, that individuals can do on their website that uses the Morningstar guidance, and it will, depending on how you might answer your various risk profiles and objectives, it could put you into different asset allocations, but that is also available to anybody. And of course, all the investment committee materials are online. Not that everybody would necessarily know that, but also in the past, Mike and or Barry have met annually as part of our employee benefits annual meeting to do a Zoom with anybody who wants to join, and all employees are invited. So there is that education piece as well.
Yeah.
Great, thank you.
Any questions before we move on to the share class analysis? And this will go really quick. Periodically, what we want to do is we want to dive into the individual funds that we offer in the plans today to ensure that they are competitive and remain competitive in the marketplace in terms of fees. When we are evaluating these, we look at Morningstar kind of peer groups, and obviously in this particular case, the lower the fee or the lower the universe percentile, the better. And so if you think about CREF Social Choice as an example, the very first one, the net investment cost is 7 basis points. The universe 25th percentile is 53 basis points. So clearly, really, really competitive fee for CREF Social Choice. The Vanguard Tiger Retirement Series is at 8. We're comparing this to other kind of index type of target date funds, so you can see they're right in line with the peers in terms of the costs associated with that. I'm not going to go through every single one. I'll point out a couple here. If you go down the middle of the page, the Vanguard Total International Stock Index, this particular index represents the full international market, so it includes emerging markets, whereas the category is more just a foreign large blend. So you can see the net investment cost is 9. The universe 25th percentile is 5, and the universe medium is 10. So I would suspect most of those at the 5 basis point range are more the developed markets that are cheaper to invest in. If you look at the bottom, just a reminder, TIA traditional, this is an interest spread contract based on the full faith and credit of the general account of TIAA. And so, they have a zero stated fee. It's more about how they earn their general account. So that's why that's a net investment cost of zero. And I don't see anything in particular here. If we go to the next page.
Yeah, and the only thing, Barry, if I can just jump in
Yep.
quickly, just a reminder, if you look at the two columns, the expense ratio, for example, on the TIA real estate, and then the net investment cost, there's a difference there.
Okay.
And that's because there is some revenue that's in there that gets credited back to the plan. So that's why it's really what we would focus on there is the net investment expense. So, thanks, Barry.
Yep. Yeah, same holds true on the next page. Again, if you look across the board, you're in in almost every case, you're in the bottom 25th percentile from a fee perspective. If not, you're really close to that. So we feel really good overall about where the fees are with respect to the investment managers that we have placed in the portfolios. So there's no action here, it's just informational.
Mm-hmm.
We can probably stop sharing, Mike. Those are our prepared comments. Is there any questions, comments?
I have a question just back when we're talking about kind of political landscape and how it affects markets. And, you mentioned, I don't know if you have, I'm guessing trade associations or groups who are lobbying in DC and talking about these bills that are important to you. What's the message that they're sending to policymakers about kind of stability and consistency? And if you know, and if you can share responses, I think that would be helpful for all of us.
Yeah, I would say, from our perspective, the focus in DC in the near term anyway has really been around the CIT legislation. I mean, there's certainly whenever they're in DC, there's other topics that they're looking at. But, a big chunk of business at CapTrust is institutional 403(b) business, where we think offering collective investment trust will ultimately benefit everyone. Obviously, most importantly, it benefits the participants in the plan. So that's really been the focal point. I would say, some of the broader, issues we really don't get involved in at this point with our lobbying efforts in terms of, for example, the big issue obviously is tariffs. That's not something that as a firm, we would kind of state a strong position on and lobby a position on, something like that.
Well, we focus on what we can,
I guess, more macroeconomic stuff.
We focus on what we can control or what we can influence, and that we're not necessarily knowing what to influence at this point.
Yeah, and I understand. I think, I think the message that we try to send to our delegation when we're talking to them is we need predictability, stability. And I think that message is strong coming from all kinds of people, no matter where you are on, which side of the aisle. Mm-hmm. You said on the 403(b), is there a legislation attached to that right now? You said it hadn't crossed the finish line in DC, but it's been reintroduced in this Congress, and it's.
Yeah, it actually, interestingly, the CIT legislation was part of the Secure Act 2.0 and which was actually passed. And so there was kind of a very brief celebratory moment, if you will, because then people quickly realized that the language of the legislation actually conflicted with securities law, and it had to essentially, it was not able to get pushed through. So they actually had to pull that piece out and completely refile it as a separate, and I'm going to forget the formal name of the current legislation, but it's something like fairness and equity for not-for-profits. It's a pretty long name, but it has been refiled, and again, it has gotten pretty broad bipartisan support. But there's a group, a very vocal group, that's kind of lobbying against it. And the biggest issue that we're seeing is that with mutual funds, you get a prospectus. There's a requirement that anyone investing in a mutual fund get a prospectus. There isn't that requirement with collective investment trusts. They're less regulated than mutual funds because they're really specifically meant for institutional investors, which, you know, arguably by definition are more educated, they understand the marketplace, and there isn't a need for a prospectus. So that's been really one of the key lobbying points. A lot of it also revolves around teachers, specifically 403(b) plans. The way we look at them as a $2 billion institutional investment is very different than the way, say, individual contract held by a high school teacher. And so, you know, that's been one of the key focal points kind of against allowing the CIT legislation. So, you know, it's certainly more complicated and nuanced, I think, than sometimes I present it. But, you know, from my perspective as someone who operates, you know, mostly or exclusively in the institutional field, I just think it's a very, very logical piece of legislation that I hope does get pushed through.
Thank you.
You're welcome.
So, Mike, I'm just curious, does that mean that there's opposition from teachers? I mean, who opposes this?
Yeah, exact. So the opposition is coming from, I'm not sure actually if teachers union, I don't want to specifically say teachers unions, but you know, the issue is that, you know, if you take an individual investor, not an institutional investor, that, you know, for forever and ever, the argument has been they need more information, they need more access to information. You know, that's where the prospectus, that's where the prospectus come into place. Right. And so there's groups that are, you know, kind of lobbying against it because of that. That's kind of the specific reason that's being cited. I can't tell you exactly, you know, the name of the groups that are lobbying against it, but you know, that's where we're seeing the opposition. Any other questions for us? Thanks very much for everyone's time this morning. We really appreciate it as always.
Mike, we really appreciate your insight, especially during this increasingly complex landscape. So thanks for what you do, and have a great weekend.
Okay. Good seeing everyone.
Thank you all.
See you. Kelly. There you are. Hey, Kel.
Good morning, everyone.
Welcome.
Thank you.
These are our consultants from NEPC, and they're going to go over the three portfolios, the managed investment pool, the pension fund, and the operating fund. Also going to go through the asset allocation, which is a voting item and emerging market manager recommendation. So without further ado, I'll hand it over to whoever's going to start.
I'll share my screen, and Matt will kick us off with a market overview and talk about portfolio performance. So I just want to make sure everyone can see my screen.
Thank you. It's perfect.
Okay, great. Matt, I'll turn it to you.
Sure. Thanks, Kelly. So maybe if we go to page 108, we can start there. And I don't want to rehash everything you all just heard, so I'll make this brief. You know, when you look at this page, one thing you'll notice is that U.S. markets were the place to be, obviously, last quarter and then in 2024 and beyond. You can see that reflected in the S&P 500 up 25%, you know, largely driven by the U.S. large cap growth, and in particular the Mag 7. You look down below that into the large cap value and the mid and small caps. I mean, really strong absolute performance. Any other year you'd take it, but to the extent you were outside of those really, you know, narrow market leadership, the stocks that were driving returns in the Mag 7, you know, you were going to underperform. When you look down to the non-U.S. markets, you see last quarter some really, you know, frankly, big underperformance there relative to U.S. markets, down in, you know, 8+%, largely driven by the strong U.S. dollar, which really weighed on non-U.S. returns there. And then you look out towards the 1 year, so in 2024, they did have some, you know, positive performance, but really lagged U.S. markets on the whole. On the domestic fixed income side, you know, struggled in Q4, but if you look at the core bonds out 2024, it did eke out a small return at 1.3%. But really the place to be in fixed income markets last year was the high yield space. You can see it was up 8.2% in 2024. Given the spread compression that we saw, you know, it's near historic lows and it actually continued to compress into 2025. So that's just a brief overview on how markets performed. Before we shift into our market outlook, I did want to maybe quickly touch on the Fed on page 114, just to show you sort of the change that we've seen more recently. The two dotted blue lines are where we were as of the end of 2023. That's the light blue line, and then the darker blue line is where we were at Q3. Actually, I think I had those switched, but the point remains the same, is that at the end of Q3, we were expecting somewhere in the 4 to 6-ish rate cuts in 2025. Basically, the rate cuts we were expecting in 2024 sort of pushed out, just postponed in 2025. Now, given some of the tariff talk that we've seen, some slightly higher inflation prints that have come out, that's really shifted higher. So now what the market is expecting is 1, maybe 2 rate cuts in 2025. And if we do get those, they'll likely be in the second half of the year. So that's going to flow through to everything that we see in markets, both on the equity and the fixed income side. So I just want to quickly point that out. So maybe if we shift to 116 and move to NEPC's market outlook here. So every year, at the start of the year, we identify some market themes we feel like are going to drive markets in the next 1, 2, 3-ish years. This year, the ones we've identified here: pockets of euphoria, AI spending, tariffs, and world affairs. I'll take each of these in turn. 1, pockets of euphoria. So these are areas in the market that we feel are clearly running hot, but in large part, we don't feel like are in bubble territory. So you think things like the Mag 7, which we've talked so much about in the past year or two. There's no doubt they're expensive, super concentrated. I think the S&P 500 is nearing, the Mag 7 makes up near 35% of the S&P 500. So really concentrated. But if you look back historically, these tend to be below past peaks. So you look back to the late 90s, early 2000s, the dot-com bubble. All you had to do during then was slap .com on your name, and your stock price raised 2x overnight. That's not really the same what we're seeing here. The companies driving this return dynamic are really strong companies. They have some good free cash flow, just strong businesses in general, but they tend to be concentrated and are really going to drive market returns like they have been for the past couple of years. There are other parts that have bubbled up, like crypto, which may be more bubble-like. But some of those, it's a little unclear how interconnected they all are with the greater financial market. So if those do sell off, is that really going to trigger some sort of recession, like it might if the Mag 7 were to just disappear? So we've identified this as pockets of euphoria, things that we're looking at for clearly running hot, but we don't think would trigger sort of a bubble moment there. The next one, AI spending. I think we all know, AI expenditures have dramatically increased. I think it's exponential year over year. And we're starting to get into that time where these companies need to see some return on investment on those expenditures. And to the extent they do, that could support some of the higher valuations we're seeing in the equity markets. It could also present some opportunities in other markets, so think, real assets or anything like that, in which sort of play on the periphery of that AI theme. These last 2, tariffs and world affairs, likely aren't going to drive market returns over the long term. What they're likely to do is increase volatility in the near term. So you think tariffs, Trump's propensity to use tariffs, we've all seen those sort of more headline risk. Sort of TBD whether these are more bargaining tools or whether they're truly things that he wants to implement. I think we've gone back and forth, and the market seesaws alongside it. By nature, tariffs are inflationary, so the Fed is looking closely at that. And then also, to the extent countries react with retaliatory tariffs, I think we just saw, Canada come out with that. So that's going to be inflationary as well. So something we're keeping an eye out. What you're seeing in markets are some really big days and some really down days. I think we're likely to see that continue going forward. But once you sort of zoom out a little bit, likely not to impact sort of that longer term viewpoint for us. And a similar story for the world affairs here. No surprise that there's tension around the world right now, geopolitical tension. Half the world's population went to the polls last year, and more often than not, the incumbent was ousted. So given change there, particularly with sort of this protectionist movement, it's going to impact inflation and growth, which could impact sort of the volatility, but really not going to be long-term issues for the most part. But it's something that we've identified as themes, especially when you go out to CNBC, you're going to see a lot of these headlines come through. All right, and then maybe I'll wrap up performance on page 125 just to sort of explain where we go from here. So we have a number of portfolio considerations on this slide. I'll just hit on three of them. The first one being to embrace diversification, that top line there. It's hard to be diversified when markets are going up as quickly as they are when it's been such narrow market leadership with the Mag 7. Being diversified tended to have less exposure to those, which, hurt active managers. It hurt a lot of portfolios around the world just to not be have some of that passive exposure there. However, we feel diversification is beneficial in the long run. It's really going to be where you want your portfolio to be positioned, especially as market breadth returns, which is what we have seen thus far in 2025. I think I heard the prior presenters mention that value has outperformed growth in 2025, which is true, which is going to be beneficial to a more diversified portfolio such as yourselves. The second one I want to touch on is that middle one, the importance of alpha. Over the past couple of years, it's been difficult for active management. When you have such, again, narrow market leadership with the Mag 7, active managers tend to be underweight to those. So it's really going to hurt the relative performance. And when beta exposure, so this exposure to some of the S&P 500 in particular, the large cap growth, when that gets expensive, there's limited room to grow there. So as market breadth expands, it's really ripe for some good active management performance. And to the extent we have good managers in the portfolio, we should see some outperformance there. And then the third and final one is that bottom one, the be boring. Don't stretch for returns. As we mentioned, the markets are expensive. They're super concentrated at the moment. We don't feel like this is an environment for stretching for those returns. We would emphasize some more boring type things. So think the asset allocation, which we're walking through today, things like the investment policy statement, just these areas in which we feel like we'll set the portfolio up, with a good foundation going forward as we come into likely some more volatile times as it comes to the markets. Any question on the markets before we jump into specific portfolio performance? Okay, not hearing any. Maybe Kelly, if we move to the next slide. Kelly Martin, did you have a question there?
More of a comment. I
Yeah.
like your slides, and I like the I like what you guys are presenting. It helps a little bit with the current state we're in with the volatility, and the be boring slide. Everybody's trying to always reinvent the wheel. That really resonates. That list really resonates with me. So thank you for that.
Yeah. Good to hear. It's hard when markets are going up like that, but it's certainly an important aspect and something we like to emphasize. All right, moving to performance, the operating fund currently at about 246 million. This was a large decrease since we last spoke, but largely due to outflows. And I think a lot of that has come in back into the portfolio in January. So this can be the more conservative portfolio, about a third in cash. We are in line with targets and ranges. This is an area where you're likely not to see some large alpha outperformance here, just given the large allocation to fixed income and cash. We see performance over the 1 year at 6.4% in line with the allocation index. And you look out 10 plus years, right on top of its index as well, or its benchmark as well. There are 3 manager announcements we'll get to in a minute. In terms of recommendations, we don't have any. We did review the asset allocation, which Kelly will touch on, but no recommendations for this particular portfolio at this time. On the pension fund side of things, currently at about 17 million, a slight decrease primarily due to outflows. It did underperform slightly over the 3 months time periods. This is going to be a little bit more aggressive. There's a larger chunk to global equity at about 29%. We are within targets and ranges here. And one thing I'll note is, I think the past few quarters we've called it the real assets line, knowing that we're getting a distribution from principal that has come through. So we've right-sized that back to its 3% target there. Some of the short-term underperformance we saw in this portfolio, largely driven from our equity managers. So think Walter Scott, which is drag over a quarter and 1 year, and then longer-term 1 year plus, some more defensive positioning like Lighthouse. Now, I'm happy to report in January, we did outperform the benchmarks in that time period, and we saw some good outperformance, in particular from some of the managers that have underperformed in Q4, like Walter Scott. In terms of recommendations here, we're recommending a review of the EM exposure, the emerging markets exposure, in particular, the Modern EM small cap strategy, and considering a replacement there that Kelly will walk through. Okay, if we move to the managed investment pool, about 374 million, slight decrease, some outflows, but it did have some underperformance in Q4 for largely the same reasons we talked about for the pension fund in the global equity space. However, currently, in line with targets and ranges. And then in January, we did see some pop in performance, about 2.3%. The two managers that we'll get to in a minute, Walter Scott and Impacts, with the two underperformers over the quarter, did outperform in January as well. From a ranking standpoint, this is going to lag a little bit from your peers. I think we've talked about this before, but just not having the dedicated exposure to private markets, given the liquidity premium that we see in the long term, could hurt relative to rankings there. And then similar to the pension fund, we're recommending a review of the EM exposure, and then doing some right sizing. It relates to the equity targets to align more with our new NEPC recommended benchmark neutral weighting. Okay. If there's no questions on that, I'm going to quickly touch on DD Monitor. In the interest of time, we have 6 managers here. I'm happy to go into any of these, but the short of it is recommending no action for any of these except for Mondrian. And we have a concrete recommendation that Kelly will walk through when we go through there. Okay. So the manager performance, starting on that next page there, I'll walk through each of these in turn. SSGA, relatively new strategy. This is going to vary relative to the S&P 500, just given how energy is doing. You can see over the 1-year time period, slight outperformance versus the S&P 500 index, which is right above it. So no concerns here. Scooting down to the Westfield Capital, just a reminder, this is more of sort of fundamental bottom-up growth at a reasonable price type manager. We do have a slight quality bias. This is a manager that we feel should outperform as market breadth expands. And so we started to see that in 2025 thus far. And when you look at the January performance, that rings true there as well. So as I mentioned in the prior section, Walter Scott and Impacts, 2 underperformers in Q4. So Walter Scott being a conservative growth manager, sort of fundamental bottom up. They, in particular, were overweight healthcare, underweight some communication services, and that's hurt them in the Q4 time period. And you look out to the 1 year, 2024, up 8.3%. So, decent absolute performance, but clearly underperforming its benchmark there. So we'd like to see that, pick up as we move into an environment that may be a little bit more favorable for them. On the Impact side, Impacts and Lindsell Train, you'll recall these are 2 new managers that we put into the portfolio recently. No fossil fuel exposure. Impacts really struggled in Q4, but has bounced back in 2025. So, we only have 3 months worth of performance to look at, so still too soon to sort of make a conviction call there. But still strong managers. We believe in our recommendation from last quarter, and we look to see those pick those back up in 2025. Down towards the bottom of the page, this is where we get into international markets. And as I mentioned at the top, international markets really struggled in Q4 in particular, given the strong US dollar. You see Silchester down 9.2%. You read their material, they're talking about mostly to currency exposure there, just given the non-US markets they play in, but something that they would hopefully outperform in 2025. And I think what we've seen in 2025 thus far is the MSCI EAFE, which represents international developed markets, has actually been the best performing asset class across the board, barring China, which had some really outsized returns, I think in early February at about 17%. So no concerns with Silchester, sort of in line with their benchmark near term, over the fiscal year to date, outperforming slightly. And then over the shorter time period, the 1 year, some slight underperformance there. And then Mondrian, I'll sort of skip over this. They did outperform a little bit in Q4, but this is a manager that we're recommending moving out of going forward. And then on the fixed income side of things, this continues to be a really strong story for the portfolio. If you look out even further out to the 10-year time period, doubling the benchmark return there, ranking really well in the 31st percentile. A lot of this outperformance due to some of your really strong managers there in BlackRock and Bain. And if we zoom back in a little bit towards the 1 year, BlackRock up 5.4%, beating its benchmark, and then Bain Capital Senior Loan Fund up 9.1%. So really strong outperformance there. BlackRock giving you sort of this less correlated alpha, and bank loans have just been a really strong place in the markets as rates have risen more recently. And then towards the middle of the page, Newton has had strong, nice one-year performance in 2024, up 7.8%. Longer-term performance roughly in line. You know, this is going to be a manager that's generally going to do better in down markets. It's not going to keep up in strong equity rallies like we've seen. So again, it's not going to give you sort of that double-digit returns that we've seen in large cap growth, but should give you good returns, particularly on the downside. Lighthouse is a very similar story to Newton, your long short manager here. Although you can see that one-year return at 10.7 versus its benchmark of 14.8. So underperforming there on a relative basis, but then you look at its ranking at 54. So ranking in line. So despite the median, or despite the, you know, relative underperformance, still ranking about median relative to its peers, just going to show that, you know, it's been difficult for a lot of active managers in this space. And then Landmark, right below that, you see some negative performance, but I wouldn't really, you know, focus on this too much. Time-weighted returns is what we show on this page. Not really all that applicable for a private markets manager. And you'll see in a later page, we have the IRR, the internal rate of return, which is a better measure for private markets, showing that Landmark is up about 10.7% since inception. Okay, there's three other managers that aren't in the managed investment pool that are in the pension and operating fund. So yeah, in the pension fund here, the two I want to hit on, Baird and Principal. Baird more in line recently, outperforming over the 1 and 3 year time periods, and ranking above median and longer time periods as well. You know, yields rose, leading to a tough fixed income environment, which is why you see that negative performance in Q4, but still in line with its benchmark. And then Principal, which is down below there, negative returns recently, just given the dynamics in real estate markets. Underperforming its benchmark slightly, but, you know, roughly in line. And then this is a position, as I mentioned, has been right-sized given the distribution that we finally saw towards the end of the year. So back down to near its 3% target. And then finally, operating fund, the one other manager I want to hit on is PIMCO. This is in line recently, you know, outperforming the 3 years and later. As a reminder, this is going to be pretty different than peers, where most might have a 60-40 portfolio, so 60% equity, 40% fixed income. PIMCO is going to have less equity exposure, so that often means, you know, rankings are going to fall below median, especially when equity outperforms. The idea is it's going to give you, you know, strong absolute returns for these steady Eddie type returns and diversification, in particular inflation protection as we move forward. And you can see that reflected in its 10-year return, you know, up 4.6%, outperforming its benchmark there. So that wraps up the manager-specific comments. Were there any questions before we jump into some of the, you know, asset allocation and implementation discussion that Kelly will walk through? Great. Well, Kelly, do you want to walk us through the next section there?
Absolutely. So bear with me as I get to the page. All right, so we're going to talk about asset allocation now. We do have recommendations for the managed investment pool and the pension fund. But just to start, you know, every quarter we look at asset class capital return assumptions. We've made some improvements to our process, specifically around equity, in terms of kind of our valuation multiples and incorporating some share buybacks into our future-looking returns. For fixed income, our return expectations have moved higher given the higher rates. And as you can see down at the bottom of the page, we continue to want to have a safe haven allocation in our portfolios, which all three portfolios do have a dedicated allocation, which is great. And then at the time of printing these materials, we were very positive on US tips. Things have changed a little bit more recently, so we have more of a neutral position. That being said, within the managed investment pool and the pension fund, there is an allocation to tips, which we are still positive on. In terms of our return assumptions here, you can see this column at the end of 2024, just different returns for each asset classes, equity, fixed income, and real assets. You can see on the right-hand side, there's a delta column. So for example, US large cap equity, non-US developed equity, and global equity, you can see that our returns from the prior year have gone up, and some of this is due to those improvements that we made to our process. I did want to point out within large cap equity over the next 10 years, we're forecasting a 5.6% return, which is relatively low. It has improved since last year of 4.4%. But you'll see when we go through the pension that, when we talk about fixed income, there are a lot of areas within fixed income, whether it's corporate credit, high yield corporate credit, and even the aggregate bond. Our 10-year forecasts for those asset classes are about 5% or higher in some instances. So we'll be talking about in the pension fund, this has been a conservative strategy. The funded status has been relatively low. Should we take on more risk to try to improve returns? But if you take on more risk, you're taking on more equity risk, and you're not getting compensated as much for that given our return outlook. In terms of our asset allocation outlook, items that we're talking to clients about is one within equity. We use the broad benchmark of the MSCI All Country World Index, or the ACWI Index, which is an index that is invested in US large cap, small cap, international large cap, small cap, and emerging large cap and small cap when we use the IMI. And we're counseling clients to be in line with equity weights within the index. For example, US exposure is about 65% of that index, international exposure is about 25%, and emerging market exposure is about 10%. In the past, NEPC had been counseling clients to have an overweight to emerging market equities compared to this index. And we have come back and want to reduce the overweight. So you'll see some of our recommendations there, mostly surrounding reducing the overweight to emerging markets and putting that capital in the US markets. Moving forward to portfolio positioning views, other items that we're talking to clients about is diversifying S&P 500 exposure, given some of that Mag 7 that Matt was talking about earlier, and diversifying that in a number of different ways. You can do it through adding large cap value, or another area that we're talking to clients about is adding global equity. Now, both the pension fund and the managed investment pool have exposures to global equity, so you're taking advantage of our portfolio positioning view in those portfolios. So moving to the managed investment pool asset allocation, just to orient you to this chart, we have all the asset classes on the left that you're invested in, your current policy, so all the weights to those asset classes in your current investment policy statement, and down at the bottom, expected return and risk statistics. So as you look at the current policy, today, over the next 30 years, we expect a median return of 7.2%, and one standard deviation return of 8.2%. So when we look at that 7.2 to 8.2 range, and we look at your expected return for the portfolio, the goal of 7.25, we think that your current policy allocation can achieve that goal. If we move to the other two columns here, we have the EM small cap shift. So one of our recommendations here is tied to both asset allocation, but also manager recommendations. You can see today you have 4.25% in emerging market small cap equity with Mondrian. The EM small cap shift is saying we want to terminate Mondrian for a number of different reasons. And when we look at the exposures that we want more of an all cap emerging market equity exposure. So we've shifted that 4.25% up to emerging market all cap equity. If we look at the bottom of the page, that one shift alone by itself does not have any change to the expected return and slightly reduces volatility through standard deviation. Our recommended portfolio that we're asking the committee to consider today is this equity weights realigned portfolio. And what we do in this portfolio is you can see with US large cap, US small cap, and emerging, that these numbers differ from the previous column. So this goes to the theme where we would like to reduce emerging market exposure to ensure that the portfolio, just looking at the equity portfolio, only has about a 10% allocation to emerging markets, similar to the MSCI All Country World. With this shift, you can see down at the bottom, again, no changes to return expectations, but just a slight decrease in volatility. So we believe that this portfolio is an improvement from where you are today. So I'll stop there and see if there's any questions on the managed investment pool before I move to the pension fund. Yes, Matt.
Hey, thank you, Kelly and Matt. I just was hoping you could walk me through the global equity logic again. I think we've had this conversation in the past, but for me, global equity is kind of a challenging classification because we're in essence outsourcing a lot of that asset allocation globally and regionally to the managers, and so we have maybe less of an idea of how much actual weight do we have to domestic equities versus foreign equities at any given point in time. So I'm just hoping maybe you can walk me through that, why we have such a large allocation to global equity rather than just expressing our views by defining for ourselves across domestic and international that way. Is it because we really enjoy those global managers and have our trust in those? Or I guess that's my question, if I'm making sense.
Making complete sense, and it's a great question. So within, I'll answer it in a few ways. So just to start, when I talk about from NEPC's views, we want to have that 65% US exposure, 25 international, and 10% EM. I'm talking about in terms of what we can control, which is these 4 asset classes here at the top. So that's where those views come into play. Within global equity, you're 100% correct that we can't control, being at that 60, 25, 10% allocation to US, international, and EM. And we're comfortable with that because these managers over the long term have proven that their ability to trade in and out of those 3 different regions has added alpha in addition to stock selection. And so this global equity position, we kind of take it out of our purview in terms of what we can control in terms of the regional weights, and it's in the portfolio to provide alpha and also reduce kind of where we would be in large cap equity. So if we didn't have global equity, we would kind of be allocating to these 4 asset classes. Our US large cap equity exposure would go up in terms of percentage terms, and we're invested today in a benchmark, right? A passive S&P 500 fossil fuel free benchmark, and that would increase our Magnificent Seven exposure. So it's kind of twofold, and let me just stop there and see if that helps answer your question.
It does. Thank you. I appreciate that.
I would just quickly add that those global equity managers manage to, the MSCI ACWI benchmark for the most part. I think there's some world in there too, but they're never going to be, way off from that benchmark anyway. So if you were to look through their allocations, they're going to be, very close to that 65, 25, 15, or 10 that we've outlined. So you're never going to get something where you suddenly look through and you're way overweight non-US given these global equity managers.
Thanks, Matt. Any other questions before I move on to the pension? Okay. So here on the pension fund asset allocation, just focusing on your current policy column here, you can see that we're, our largest allocation is within fixed income at 48%. Historically, this has become a portfolio as the assets have decreased to around, call it 18 million or so, and the benefit payments were going out pretty sizable every year, that, this portfolio couldn't withstand a lot of volatility from the equity markets. So we had been more fixed income oriented. If you could look at the bottom of the page, the 30-year expected return at the median is 6.6%. And if we look at 1 standard deviation out, that's 7.4%. So we think that this portfolio under the current policy can earn anywhere between 6.6 and 7.4% over the next 30 years. And your current expected return target is 6.25. And so I have some language up here in the top right of the page that, Tracy has conversations with your actuary every year. NEPC provides a expected return memo to help the actuary establish that 6.25 goal. And given that the range of returns are higher than 6.25, we do think that there's opportunity to have discussions with the actuary to increase your expected return target. And by doing so, that naturally would reduce your liability slightly and improve funded status performance over time. So just want to stop there and mention that. Tracy, not sure if you have any comments that you want to make in addition to that, but I do think there's opportunity here.
No additional comments, but that would be great to reduce the liability. We'll have a conversation with KMS, as I think they believed that the rates have been too high. So at a minimum, that would give us some good returns if we stabilized at the current rate anyway. Here.
Yeah, absolutely. The next item I want to talk about is our recommendation. So that's this middle column here, where it's titled Eliminate Emerging Markets and Diversify Global Equity. So it's both asset allocation and kind of a manager recommendation all in one. So as we mentioned earlier, we would like to terminate Mondrian. And you can see that, going down to no allocation to emerging market small cap. And as Matt and I look at the portfolio, certainly we could recommend hiring Acadian, which is what we're recommending for the managed investment pool for the emerging market recommendation. But the size of the portfolio is relatively small, and to have that such small allocation of around 3%. So what we are doing is we're recommending moving to a more diversified global equity portfolio, similar to what we did in the managed investment pool. So adding Lindsell Train and adding Impacts, which are the two managers that are in the managed investment pool, to the pension fund is something that we're recommending today. Just to remind you all, some of the reasons why we did hire Lindsell Train and Impacts in the managed investment pool were a number of reasons. One, when combined with your current manager, Walter Scott, it improved upside potential in terms of outperforming benchmarks over the long term, and actually improved downside potential, meaning tended to outperform benchmarks more when markets were down. These managers had a very nice long track record. Their fees were reasonable, and both managers do not invest in fossil fuels, which is also important given the divestment goals. So again, that would be our recommendation for the pension fund. And if you see at the bottom here, over the longer term, it's expected that the return would be 6.6% to 7.2%. That higher end of the range comes down about 20 basis points because you're taking out the volatility that you would get from emerging market small cap, which is relatively high. So I do still think that there is opportunity, if you did approve this recommendation, to still talk to the actuary about a return in the range of 6.6 to 7.2. Before I stop with this, I did want to just touch upon this last column, which is not a recommendation, but is just here for discussion with the committee. What we did is we added 10% to equity and reduced fixed income by 10%. You can see going from 33 to 43 in equity, and then 48 to 38 in fixed income. There's been some discussion about, are we taking enough risk in the portfolio? Should we take more risk? And today, the efficient frontier is relatively tight. And as I showed you those capital market expectations earlier, you can earn pretty much a similar return in some fixed income asset classes than you can at some equity asset classes. And so what you can see down here at the bottom is that return can go up about 10 or 20 basis points if we look over the next 10 or 30 years. But what you're doing is you're increasing risk a little bit, going from 8 to almost 10%, and reducing the efficiency of the portfolio when you look at your Sharpe ratio or your risk-adjusted returns. So it's not a recommendation we're recommending to you today. That being said, if the landscape and the markets change, there could be opportunity to increase risk, but today we don't believe it is appropriate. So I'll stop there and just see if there's any questions on the pension fund and the recommendations there.
Kelly, could you speak to your last bullet about combining?
Oh, yes. Thank you for bringing that up. I missed that, Trish. I appreciate that. So as the portfolio is about 18 million or so, the asset, size has come down quite considerably. And Tracy and I have had discussions to see if there's an opportunity to maybe from more of an accounting perspective, take the pension assets and invest it maybe all in the MIP if we want to take on more risk, or invest it in a combination of the MIP and the operating fund to get the right risk profile because the MIP's a little bit more aggressive, the operating fund's a little bit more conservative. Pension fund today, we want it to be relatively moderate risk. Could that minimize complexity in terms of kind of these managers we have to hire, the paperwork, the rebalancing, things of that nature? So no recommendation on doing that today, but it was a point that I did want to bring up for the committee's consideration and just see if there's any feedback or concerns if we did continue down that path of exploration and come to the committee with a recommendation to change the accounting structure of the pension fund.
And there's no ERISA prohibitions about combining pension funds.
Again, something that we need to explore. Again, I think, Tracy, maybe you can comment a little bit, but I think it's more of an accounting type of structure than it is kind of an ERISA issue.
Right. I mean, so we could accomplish it for accounting purposes. I mean, the primary goal would, we have a lot of duplication of managers across the three portfolios. And if we could aim at a similar sort of risk and return profile by an allocation to both the operating fund and the MIP, certainly not the MIP entirely, because that would be more risk than the pension should be bearing. But it's not unlike how our endowments are in the MIP or our OPEB is in the MIP. So there would be no violation. And actually, we're non-ERISA as an entity. We follow this as best practice. And there would it be like just a pro rata allocation depending on which managers or pools we were to invest those funds. We're down to 17 million. It's a lot of extra work to maintain three portfolios, pay our advisor for that. So it's something we've touched on over the years, and it's just revisiting it, given we're getting pretty low in our portfolio balance as we wind down those the closed pension plan. Does that make
Sounds
sense?
smart. Yeah, sounds smart. Thanks.
Jim, I see you have a question.
And it's more a curiosity thing than anything else. As the pension fund has shrunk to kind of a rounding error as far as the university assets go, has there ever been any contemplation about offloading the pension administration to a third party?
We did evaluate that well over a decade ago. At that point, we were overfunded, but by doing that and selling off to an insurance company, we actually would have gone into an underfunded position. And we're already in an underfunded position. So it just wasn't something, that we wanted to take on at that time, being it really wasn't profitable to do that. But we have had conversations with our actuary to see if there's something we can do, and we can certainly revisit that. I mean, we could reach out to individual pension holders who have very small balances and to see if they would want to take an actuarial equivalent payout. Something we have looked at in the past, and it wasn't the right time to do that, but I appreciate you suggesting it, and I'll mention that again to see if that's something we want to take a look at.
Super.
Okay. On the next page, here we have the operating fund allocation. There's no recommendations here. I just want to point out that the current policy target can support the return goal of 4%. You can see the return range is 5.4 to 5.7 over the next 30 years. The range is relatively tight compared to the other portfolios because you can see here the standard deviation is only 3.7%. You also can see that, if we have a one standard deviation event, you still would possibly have a positive return. If you just kind of take 5.4 minus 3.7, you're earning more return in this portfolio than you are taking risk. So we believe it continues to be well designed. So I'll stop, and Trustee Martin, I'll turn it over to you. Do you want to take the committee's pulse on approving the recommendations?
Sure. Thank you. Thank you for the presentation, Kelly and Matt. Always good. And I love your materials. It really bring us back to the principles of investing. So especially in these times. So thank you. And I'm going to go to tab 5, the asset allocation review and recommendation. I will read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the following asset allocation recommendations. The managed investment pool, reallocate emerging market small cap equity allocation to emerging market all cap equity. And then secondly, realign the equity targets to NEPC's preferred MSCI ACWI IMI benchmark neutral weights by increasing the large cap equity by 1%, increasing the small cap equity by 0.25%, and reducing emerging market equity by 1.25%. In the pension fund, reallocate the emerging market small cap equity allocation to global equity. And that is the motion. Do I have any questions or any discussion on what I just read? Hearing none, can I have a motion?
So moved.
So moved by Chair Riley,
Second.
second by Chair Baldacci. And Beth, could I have you please take the roll call for the vote?
Trustee Martin,
Yes?
trustee Riley,
Yes.
trustee Moore,
Yes.
trustee Baldacci,
Yes.
motion carries.
Thank you. And I'll move on to tab 6, the emerging market manager recommendation. I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment
Trustee
Committee.
Martin, can I interrupt? I apologize. We should wait on this one because I still want to walk through the presentation on the recommendation to hire Acadian. Sorry about that. Okay, so moving on to tab 6 here, just to talk about Mondrian. We are recommending that you terminate Mondrian today. You have about almost 15 million invested with Mondrian in the managed investment pool and about 400,000 invested in the pension fund. At the last meeting, we talked about NEPC's hold recommendation on Mondrian. So that, as a reminder, we have 4 factors of our watch list. It goes from watch to hold to client review to terminate. So this isn't a termination across all of our clients, but specific for the University of Maine system, your consulting team here today is recommending a termination for a number of reasons. One, we've seen the strategy lose a number of assets and clients. They used to have roughly about $2 billion in the strategy about 10 years ago, and now they have just shy of 170 million. As Matt walked through the performance materials, if you looked at the long-term numbers of Mondrian versus the emerging market small cap benchmark, you can see that they underperformed over all time periods except the recent quarter. So again, performance has struggled. And one of the things I do want to say, though, is even the performance has struggled versus its benchmark. Having the allocation to small cap in the portfolio actually was a benefit because small cap equity outperformed large cap emerging market equity. So do want to say that even though the performance versus benchmark struggled, it was a value add from an asset allocation perspective in the portfolio. Matt and I have concerns about clients leaving the portfolio. There is a large pension fund in the portfolio, in the Mondrian portfolio, and if they leave, most of these assets will be gone as well. So really wanted to recommend to the committee to get it out today, given our concerns around all these issues. So what did we do? We looked at a search, and as we mentioned earlier, we wanted to move to all cap equity that has both large cap and small cap exposure, given it's the sole manager in the portfolios. We wanted to look at managers that have a core approach. That means they invest in both value and growth sectors. And given the divestment goals, we wanted to look into the managers that we're profiling, what their allocations to fossil fuels were. As a note, we did include a manager in our search process, Acadian fossil fuel free emerging markets. This is the manager that we are recommending, not solely because it is fossil fuel free, but as I show you in a few minutes, the performance and a lot of the characteristics of the strategy are also very attractive. I say this because it is not a one-rated strategy at NAPC, because the other managers are one-rated. This is not. However, Acadian's flagship emerging market equity product is one-rated at NAPC. This fossil fuel version is the exact same thing as their flagship product in terms of team, process, the quantitative models they use. So we're comfortable today recommending this to you, but did want to point out it has not gone through our complete due diligence. That being said, it's similar to past recommendations that we've had with all of you around the Silchester product, where the flagship strategy is one rated, but the fossil fuel free version is not rated. But again, same process, same team. I'll walk through the bottom here, but you'll see that the strategy has strong trailing and calendar year performance. When we look at the performance in both up and down markets, it's the one manager that profiles very well in both markets. What's interesting about Acadian, one of the things that Matt and I really did like was that Acadian goes up and down the cap spectrum. And so out of all the managers, this strategy with Acadian does have some good small cap exposure. So did want to make sure we had that exposure given that we're moving to the all cap approach. There are some managers that kind of stay more large cap. Acadian does go down into small cap, which we like. And then fossil fuels are excluded, which is important given your divestment goals. The one consideration to talk about, and I'll just move to the next page here, right here. You can see Acadian highlighted. In terms of assets, there's about 17 billion in their flagship strategy, but only 329 million in the fossil fuel free strategy. So I did want to point that out because I did just tell you we're concerned about Mondrian because they only have 170 million in their strategy. Well, that Mondrian only has a few clients left in that strategy, one very big one. The Acadian strategy has 26 different clients, and the assets have been growing given certain clients' preference to start divesting away from fossil fuels. So again, not concerned, understand why the assets are where they are for Acadian, and it's a little bit different story for Mondrian. These are all the firms that we looked at: ABS, Acadian, both strategies, the flagship and the fossil fuel free, FIAM, which is Fidelity, Global Delta, which is a very interesting strategy. The woman who manages this strategy actually came out of Acadian and did run a lot of the ESG efforts at Acadian. It's a newer strategy. You can see the year it was founded in 2022, so it's got a limited track record. It does not have any fossil fuels, but we did consider it, but more comfortable bringing you a strategy for recommendation that has a longer track record. And then the last one being Schroeder. Moving on to this page here is just performance net of fees. At the top, it's the trailing returns through the end of December 2024, and the bottom is calendar year returns. We've highlighted the Acadian fossil fuel free strategy, and you can note a couple things. One, in time periods where markets are struggling over the quarter, where the benchmark was down over 7%, Acadian had protected during this short time period. Over the last 3 years, overall, emerging markets have struggled, benchmark down about 1.5%, and Acadian has been able to add value during the last 3 years. And then over the longer term, 7 years here, you can see outperformance versus the benchmark. And additionally, outperformance versus the flagship strategy of being up 3.7 versus the fossil fuel free of up 5.1. So again, think highly of the flagship strategy. And think that given that Acadian uses the fossil fuel free strategy uses the same process as the flagship strategy, we think that's a good thing. Down in the calendar year returns here, I just want to point out a couple things. One is that when markets are down over a full 12 months, as such as 2021, you can see Acadian added value. Even in 2022, where markets struggled, they added a little bit of value there. And then in 2018, a little bit of underperformance, but not too far off, and some better performance compared to some of the peers. Some of the other characteristics that we look at is excess return, tracking error, and then the combination of those two, which is information ratio. You can see the information ratio is positive and strong over all time periods, and actually more positive than the flagship product above it. The tracking error, that's the deviation, the volatility of the deviation of returns from benchmark. You can see it's a little bit lower than the flagship strategy, which helps leads to that higher information ratio. Down at the bottom here, we talk about upside and downside capture. So for the upside capture, you're trying to find a manager that has above 100%. For the downside capture, you want to try to find the manager that has less than 100%. And you can see that the Acadian fossil fuel strategy over the last 3 years and 5 years has upside capture of above 100%. So when markets are up, they tend to be up more than markets. And then the downside capture, the best of the group here, when markets are down, Acadian tends to be down only 80% of what markets are down. So good downside capture. And then on page 219 here, this is just looking at the market capitalization. And I highlighted here in green for Acadian, you can see that they have good exposure to some of the smaller capitalization companies, which is something that we like and brings in diversification. The rest of the materials are just talking about kind of our thought process for Acadian, why we have it rated as 1 in terms of the flagship strategy, NAPC. You know, just for your background, Acadian is a quantitative manager, meaning they use models and factors across valuation characteristics, price trend characteristics, quality characteristics, and earnings to help their stock selection. But specific, and they use this model across all asset classes that they invest in. They have large cap, small cap, international, emerging. So they use this model across all. One of the different things for the emerging market equities is that they also take in a top-down country model into their process in terms of kind of determining which countries that they want to focus on. So it is a top-down and a bottom-up investment process. And as you can see with the numbers, very strong track record. They've been doing this since 1977, and have been very successful with it. So I'll stop there and see if there's any questions for the committee. Again, the recommendation for is just for the managed investment pool, and then I believe also in the recommendation in tab 6, Trustee Martin, is the recommendation to hire Lindsell Train and impacts for the pension fund. That's where we bucketed that recommendation as well.
Thank you, Kelly. Had a hard time with finding my mute button there. Really appreciate the diligence and time you put in coming up with this recommendation. Any questions for Kelly on what she just went over? Okay. So without further ado, I will read the tab 6, the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the following manager recommendations. Managed investment pool, terminate Mondrian emerging market small cap and replace it with Acadian emerging market fossil fuel free for approximately 3% of total portfolio assets, and use the residual proceeds to rebalance the equity portfolio consistent with the allocation targets. In the pension fund, terminate Mondrian emerging market small cap and use the proceeds to diversify the global equity allocation. Trim the allocation to Walter Scott Global Equity Fund down to approximately 11% of the portfolio assets, and hire Lindsell Train Global Equity and Impacts Leaders for approximately 11% of the total portfolio assets. Any questions or discussions on what I just read? Hearing none, can I have a motion?
So moved.
So moved by Trustee Moore,
Second.
seconded by Trustee Baldacci. And Beth, could I have you take a roll call, please?
Yes, Trustee Martin,
Yes.
Trustee Riley,
Yes.
Trustee Moore,
Yes.
Trustee Baldacci.
Yes.
The motion carries.
Excellent. So we are at the end of the meeting, but I'd like to introduce somebody who jumped on the call. I'm pleased to introduce, we have a new trustee, Riley Worth. And he recently joined the University of Maine System Board of Trustees. Riley brings a lot of experience with his leadership roles in student government, his work in campaigning with candidates in the Down East and Bangor area. I believe these are Senate candidates, and his studies in political science and economics. We're excited to welcome him to the investment committee. And Riley, I hate to put you on the, I don't know if he still stayed on here. I'm looking, there you are. Riley, I hate to put you on the spot, but would you like to introduce yourself, say a few words?
Yeah, thank you for the surprise introduction. I appreciate it. I thought I was just going to be in the background watching today. It's
Yeah.
nice to meet everyone. I have recently finished my orientation about the end of last week, so looking forward to get started with this first upcoming meeting this weekend. Being able to meet everyone in person will be great. It was very interesting to hear all the different investment portfolios. This was part of my undergraduate years was focused on this, so it's nice to see it in practice. So thank you for having me.
Excellent. Thank you for those words. And we welcome you and look forward to working with you. So with
Nice to meet you, Riley.
And I apologize for the surprise. We moved
Welcome.
fast, Riley.
Oh, that's good. I'll keep up.
Welcome, Riley. We're excited to see you in person this weekend.
That's true. A couple days away, 2-3 days away, we'll be all together. So any other comments before we adjourn the meeting? Kelly, Matt, thank you so much for bringing us through that and taking good care of those portfolios. Appreciate your recommendations and your diligence. And thank you to all committee members for your commitment to this investment committee.
Thank you. Thanks, Kelly.
So
See you this weekend.
See you. Motion to adjourn, I guess not needed. Let's adjourn.
Bye,
See
everyone.
ya.
Bye.
Yep. Bye-bye.